Hi दोस्तों, welcome to today's video. This is the beginning of a beginner part series. We will do multiple parts in this stock market beginners series, which will be available freely on to YouTube. So, what we are going to cover in this session is main five key terms that you should know on to when we consider investing and what are the takeaways. See, this video is for all the members who are new and who are advanced as well, because in this video I'm not going to share only the basics, but also I'm going to cover much more than that. I'm going to cover my own experience of 15 years of investing and trading in the market, many failures that I have encountered, which is something that you can really make best upon. So this such kind of experiences I'm going to share into this video. So do watch this video till the end, because it is going to turn out to be a beneficial one for you. So let's start to understand at first what are the five key basic terms that we should know before investing. These are the five terms that I will walk you through. First is when we talk about a stock and a share, what that is, a share market, what that market is. So it is a place, okay, where people buy and sell their ownership of different shares. So when we say that they buy and sell ownership, that means out of the available ownership of a particular company, they own a specific share of that company and they sell that particular company. These shares which you buy are held into your demat account. We call it as a demat account because these shares are stored in dematerialized format into those demat account. मतलब इसका कोई physical share नहीं है, अभी it is all available as a digital shares. It is stored into your demat account with the depositories. Okay, so it's like an auction house where people come and buy these shares. So when you buy any particular stock, we have to understand that we are not buying a piece of paper, we are buying a piece of a company. There is a big difference. So when you say you're investing in a particular paper, say example fixed deposit, when you invest your money into a fixed deposit, the bank gives you a fixed deposit voucher. Okay, so this is the paper which gives you the confidence and a trust that your invested money is safe with this particular bank at XYZ return onto it. Okay, but you're not owning the piece of a bank. It is your own money. But when you're buying a share, there is a difference. Okay, in case of FD and fixed deposit. But when you're buying a share, that means you're owning a piece of a company. Now, many beginning investors, as you are starting, you will face in your life that whenever you invest in a particular stock, the stock may go up or it may go down. We have to understand that this is the nature of the stock market. Every stock will go up and the same stock will again come down, it will again go up. But what we need to track as an investor is the fundamentals of the company, the business itself. The businesses don't move in this fashion, the stocks move in this fashion. So stock and business, these are two different things. Okay, no one really teaches this concept. This is not same thing. Stock is a portion of the business, which is the shareholding, but business has many things. It has operations, it has supply chain, it has inventory planning, it has employees working under it, it has growth plan, it has expansion, and many such things. So these are two different things that we need to understand. A stock and a business, these are two different things. What people invest is they invest in a stock. No, as a beginner, you have to make it clear in your mind that what you are going to invest is into the business and not that stock. Second key term that we need to note is bonds. Bonds is similar to loans. Okay, so example, you go and take a loan from the bank. So bank gives you a loan and you promise, okay, you promise to pay some 8% return to that particular bank. Okay, so this is like you borrowing this loan with an interest of 8%. But similarly, even companies, government, different institutions, organizations, they also borrow money from janta, from public. Okay, so if there is a company, say ABC, they have two options to borrow money. One is from bank and the second is from individuals. Okay, so when they borrow money from individuals, okay, so then individuals, they are supposed to pay some return to these individuals. Okay, so that's where the individuals are lending the money to this particular company and this company is promising to pay some return to this individual. Okay, so this money is the principal amount and the return is called as a coupon rate, okay, which is, let's say, 5%. So instead of you borrowing money, you're lending it to the company. Okay, so company is borrowing from you. Okay, that's where the bond is. So when we say GSEC, that means government securities. These are bonds. We have corporate bonds. Okay, then USMA we have treasury bills. Okay, treasury bills means government itself in USA is lending this is borrowing this money from normal public, normal companies. Okay, but not borrowing from banks. So you are the investor over here, the issuer or the company, they borrow from you. In return, they promise to pay you some percentage return. In this case, as we saw, it was 5%. Okay. And then they return the full amount at a face value at a specified date, which is called as a maturity period or a maturity date. Here, there's a key term that we need to note is when we say interest, it is also called as coupon. So in many news channel or news articles, you will see there is a coupon rate. That means what is the rate of interest this particular bond is agreeing to pay back to you as a promise. So example, if you are investing 10,000 and the company promises to give you at a coupon rate of 5%, that means every year you will get 500 rupees as a interest from this particular investment of 10,000. So for you, you're investing, but basically you're giving a loan to different companies. Okay. That's what a bond means. Now, why do people invest in bonds? It's much safer to invest, but then there is no much high return out of bonds. There is a fixed return. So that is the reason why they invest. It is a good asset class for a diversification in your portfolio. Everyone should have some kind of bond investment just to hedge against any uncertainty or risk that you would invest in a different stocks. Okay, like government, US Treasuries, Indian GSEC, these are different types of bonds, but they carry some little risk, especially when we talk about private company bonds. So there are many small and medium enterprises, SME companies जो होती है छोटी छोटी companies, they also issue a corporate bond because many times banks don't lend them. Okay, so because banks don't lend them, they have no option to go and raise money from individuals. Now another reason that they raise money is they don't want to dilute their shareholding, which they have two different companies. So instead of diluting, they borrow the money from individuals or different companies. Okay, here, and then they promise the coupon rate to it. Okay, some X percentage, whatever it is. That's the interest rate. Now, that is also to remember that the interest rate and inflation can affect the bond values because because of inflation, what happens is because this company also have certain return to make on the money that they are borrowing. So if there is this company which is borrowing, say, at a rate of 8%, so it has to ensure on this borrowed, say, 1 crore from normal janta, from normal public, it has to make sure that it gets a return of more than 8%, at least 10-12%. तब जाकर it will make a sense for them, right? So that's what this point is to remember. The public company, we need to note that what is a public company? Public company is simply any business which is available to the public to invest into a stock market. So anyone, including you, can buy the shares of these companies. Where are they listed? They are listed on specific exchanges like National Stock Exchange, Bombay Stock Exchange, New York Stock Exchange. The companies usually go through a process of an IPO, okay, initial public offering, to listed stock. Why they go public? Mainly for two reasons. One is growth and expansion, and secondly, to pay off the debt. So you have to see whether the company is raising money for growth and expansion, which is a good thing, or just to pay off a debt. If it is pay off a debt, it might not be a good signal to really invest in that company. Okay. Also, these companies go public because there is a lot of visibility, valuation increase. Privately इतनी valuations मिलती नहीं है, public को growth, visibility मिलती नहीं है, right? Brand building इतना strong नहीं हो सकता है. So all those reasons factor in. That is the reason that they go public, not just to make money, but also to establish their brands. Companies like Apple, Tata Motors, these are some of the examples. This is the term that you need to know, last term, which is ROI, return on investment. So any investment that you make, the profit that you get out of that investment, so that profit divided by your original capital, you get an ROI percentage. Okay, that is called as a return on your investments. This term you will come across a lot in your investing journey. So it helps me compare if I'm investing in two different asset class A and B. Say this is real estate and this is stock. So out of that, how much is my return from different asset class? I can see and compare that so that I can make some smarter decisions into my investments for a longer period of time. So this return, this profit which you got, say you got a profit of say 50,000 rupees on your investment of 5 lakh. Okay, so your ROI was 10%. This profit which you got, it is also called as a capital gain. Okay, from that particular stock or from that investment of any asset class. But then when you invest in a stock, the company also gives you dividend. When it makes a good profit, it shares the profit, little bit of portion of that with multiple different investors who have invested in them. So the dividend is something that you get out of this company. That is also a term that you should know. Then there is blue chip stock. Again, this is an old term now. Blue chip means any company which is financially sound, which is a very big, large market cap company, is more than say 50,000 or 1 lakh crore, which is generally considered as a blue chip stock, which has stable earning and a strong balance sheet. Okay, they are reliable reputation companies. How to invest into a blue chip stock? There are different strategies. In fact, blue chip stocks can give you very good return, only if you know the technique of investing in that, which I will cover up as we go further onto our stock market video series. Then why investors invest into this blue chip stock? It is mainly because it is a low risk investment. Okay, it is good for long term. Long term always pays a lot to investor. I'm telling this from my experience. I used to trade in the beginning. Then I switched to weekly swings. Trust me, this is something which no one will tell you. Then now I'm really looking out for an investment of 1 to 2 years or even 3 years of horizon. The reason is what I understood was in a swing trading I used to get like 2-3 percentage in every trade. In a swing trading, like in a day trading, in a swing trading I used to make around 10-12 percentage, okay, in 2 to 3 months of time frame. But what I understood was overall when I hold a stock for good 2-3 years, the stock multiple times gave me more than 100% of return, which was equivalent to a yearly return of 30 percentage for doing less work. So I see my productivity improvement in a long-term horizon investment. Okay. That is why everyone really emphasizes on a long term, but long term does not mean that you invest for next 25-30 years. That's not what long term is. Long term means you invest it for 2 to 3 years because market dynamics change rapidly. The key takeaways, we learn about frequently used terms. There is a demand and supply. This is an economical indication. We have to understand how that really works. We will cover that in the following up session. Long-term investment is the best investment. Researching and these things are essential for you to begin your investing. Managing your risk to reward is important. There is a risk to reward ratio that I usually maintain minimum of 1:3. One means risk. So अगर मैं 10% का risk ले रहा हूँ किसी stock में, that means I'm aiming for a 30% return. That also is called as a 1:3 investment, risk to reward. One important lesson that I learned, which you should also know in the beginning, is that लिख कर ले लो ये, that do not put all your eggs in one basket. Okay. Though now that can be different asset class like stocks, bonds, golds, real estate, liquid funds, mutual funds, ETF. Don't put your all your money in only just one of the asset class, and even within that asset class, don't put it in a just 2 or 3 stocks or just a single stock. So that's the important lesson which I also learned. So don't put that, don't take that risk. Taking a balanced approach always helps, and keep learning because this is an endless journey. This is just the beginning part series. I'll make more parts to this. Keep learning, continue learning because Ketanaki, like I forgot the name, but yeah, I think Warren Buffett only said that investing in learning pays the best interest, which is very true. Because this is like an ocean. There can be no limit when you can say that I know stock market completely. No. See, the money that you will make from stock market, you have watched this video till here, so I'll give you one important lesson. The money that you may make in the stock market is the result of your skills. What many people focus on is growing their money. Okay, they want to make more and more money by trying different options, trading and swing trading and all of those things. No, you have to focus on improving your skills. When you improve your skills, money automatically follows. Okay, so money will come as and when your skills improve. That is the success mantra which you will realize with time. So in the beginning, take a note that the focus of yours should be on improving the skills and not to make money. That will happen. But if you aim on making money, your skills will not improve. So better focus on the left side of the puzzle, which is your skills. The right side will automatically happen. Thank you so much for watching. That's all for today's video. I will see you in the next video. Thank you.